On January 14th, 2026, a line that had defined the silver market for generations quietly disappeared. The Shanghai Gold Exchange officially closed the physical price of silver at $101.71 per ounce. This was not a momentary spike, not a speculative flash on a futures chart, and not a media exaggeration. It was a confirmed physical closing price in the world's most important marketplace for real metal. With that single close, silver crossed the century mark. The era of double-digit silver ended not with chaos or celebration, but with confirmation. For decades, $100 had been treated as an impossible ceiling, a number spoken about but never reached in the physical market. Shanghai did not test it. Shanghai settled above it. What makes this moment decisive is not just the number itself, but where it occurred. This price was not set in a paper-dominated Western exchange. It was established in the physical hub, where industrial users, refiners, and sovereign buyers transact for immediate delivery. This was the price paid for silver that changes hands, not silver that exists only as a contract. Markets often talk about resistance levels, psychological barriers, and round numbers, but the century mark in silver was different. It was not a technical threshold. It was a classification boundary. Below $100, silver could still be described as cheap, abundant, or industrial. Above $100, that language collapses. History shows that when an asset crosses certain numerical thresholds, perception changes permanently. Bitcoin above $1,000 was no longer a novelty. Gold above $2,000 was no longer optional. Silver above $100 is no longer ignored. The human brain does not process three-digit pricing the same way it processes two-digit pricing. Once crossed, there's no return to the old mental framework. This is why the Shanghai close matters more than any forecast. It signals that silver has exited a psychological category it occupied for decades. It is no longer treated as a minor metal waiting for validation. It has been reclassified, quietly and officially, by the market that consumes the most physical silver on Earth. The century mark was never resistance. Price is not just a number, it was recognition. It is a signal that the human mind uses to sort assets into categories. On one side of a threshold, something is perceived as common, accessible, and replaceable. On the other side, it becomes scarce, strategic, and protected. Silver crossing $100 did not merely change its valuation. It changed how it is understood. For decades, silver occupied a contradictory role. It was essential to industry, embedded in energy systems, electronics, and manufacturing, yet still spoken about as if it were inexpensive and plentiful. That contradiction survived only because the price allowed it to. As long as silver remained below three digits, the mental framework holding it in the cheap metal category remained intact. The Shanghai close at $101.71 shattered that framework. Once an asset trades in three digits, it is no longer processed the same way. The human brain does not anchor to past prices. It anchors to categories. Silver is no longer mentally grouped with bulk commodities. It is repositioned alongside assets that are measured, defended, and accumulated. This shift has precedent. When Bitcoin crossed $1,000, it stopped being treated as an experiment and began to be treated as a store of value. When gold crossed $2,000, it stopped being debated and started being acknowledged. In both cases, the most important change was not volatility or adoption, but perception. Price crossed a threshold that the mind could not ignore. Silver's move follows the same pattern. Once the century mark is broken in a physical market, skepticism loses its anchor. The arguments that silver is too cheap, too abundant, or too industrial collapse under the weight of the number itself. The debate does not end because everyone agrees. It ends because the framework that supported disbelief no longer functions. This psychological reset does not require headlines or confirmation from authorities. It operates silently. Industrial buyers, institutional allocators, and the public all internalize the same message in different ways. Silver is no longer something to dismiss. It becomes something to explain, to justify not owning, or to chase after. The market does not need to convince people that silver is valuable. Crossing $100 does that automatically. The psychological reset becomes impossible to ignore when the market reveals a deeper fracture. On January 14th, while Shanghai closed physical silver at $101.71, the United States price told a different story. U.S. spot silver reached a record high of $92.23, yet remained nearly $10 below the physical benchmark set in Asia. This divergence is not a technical curiosity, it is a structural signal. Two prices now exist for the same metal, and only one of them represents what buyers are actually paying to take silver home. The Shanghai price reflects immediate physical settlement. It is the price paid by industrial users who require delivery, not exposure. The Western price, by contrast, remains anchored to a paper-dominated system where settlement can occur without metal ever changing hands. A $10 gap between these two markets does not represent disagreement. It represents stress. When physical silver trades at a premium large enough to overwhelm transport, financing, and insurance costs, arbitrage ceases to be theoretical. It becomes mechanical. Metal flows from where it is priced cheaply to where it is priced honestly. The episode frames this gap as unsustainable. As long as Shanghai is willing to pay more than $100 for immediate delivery, silver held in London and New York becomes a target. Vaults in the West are not insulated by contracts or benchmarks. They are vulnerable to extraction when the price incentive becomes strong enough. This is how convergence happens, not through debate or announcements, but through movement. Bars leave warehouses quietly. Inventory reports lag reality. By the time prices adjust, the metal is already gone. The U.S. price does not catch up because of sentiment. It catches up because supply has been pulled away. The existence of two prices exposes a deeper truth. There is no global silver market operating on a single clearing mechanism. There is a physical market that sets reality and a paper market that reacts to it. When those prices diverge by $10, the direction of resolution is not ambiguous. Only one of those prices can survive. When price differences reach extreme levels, markets do not correct through discussion or policy. They correct through movement. The $10 gap between Shanghai's physical silver price and the Western paper price activates one of the most powerful forces in commodities, arbitrage. Arbitrage is not speculation. It is extraction. When silver can be acquired in one market and sold immediately in another for a guaranteed spread, capital does not hesitate. The trade is executed again and again until the imbalance disappears. In this case, the imbalance points in only one direction. Silver leaves where it is undervalued and migrates to where it is scarce. The episode emphasizes that this process does not make headlines while it is happening. Bars do not vanish overnight. They are drawn out gradually, shipment by shipment, under the radar. Vault reports remain calm even as inventories are being repositioned. By the time stress becomes visible, the metal has already moved. This is why the Shanghai price matters more than Western benchmarks. It represents the clearing price for immediate delivery. When industrial buyers in Asia are willing to pay more than $100 for silver now, metal stored in London and New York becomes surplus inventory in global terms. It does not matter where it sits on a balance sheet. Price dictates a destination. The arbitrage drain does not require panic or public participation. It is executed by a small number of well-capitalized actors responding to math. Every ounce moved tightens availability elsewhere. Every shipment narrows the buffer that allowed Western prices to lag physical reality. Eventually, the gap closes, not because the West chooses to reprice silver, but because there is less silver left to price. Futures markets adjust only after physical markets force them to. By the time convergence is visible on a screen, the underlying supply has already been reshaped. This is how vaults empty in modern markets, not with alarms, but with incentives. The most revealing signal in any commodity market is not price alone, but how banks respond when price escapes control. In silver, that response has now crossed a critical line. Commercial banks that historically held large short positions are no longer positioned to suppress price. They are repositioning to profit from it. For decades, these institutions functioned as the dominant sellers in the silver market. Their short exposure helped anchor price, absorb demand, and reinforce the perception of abundance. That model depends on one assumption, that physical metal remains available in sufficient quantity to backstop paper positions. The episode makes clear that this assumption is failing. As physical supply tightens and arbitrage drains metal toward Asia, banks face a choice. Continue suppressing price and risk being unable to source metal when contracts come due, or abandon the role entirely. The shift now underway reflects that decision. Commercial positioning data shows banks moving net long, a reversal that signals capitulation rather than confidence. This transition is described not as strategy, but as necessity. Once the probability of physical shortage rises, the cost of being short becomes asymmetric. Losses are no longer limited to mark-to-market fluctuations. They extend to delivery risk, liquidity stress, and reputational exposure. Under those conditions, survival replaces control. The episode characterizes this reversal as a transformation from suppressor to propeller. Institutions that once leaned against price are now aligned with it. Their capital no longer absorbs rallies. It amplifies them. When banks shift from selling into strength to buying dips, the character of the market changes fundamentally. This is why bank capitulation matters more than any technical signal. It removes the final structural brake on price. Without large, persistent sellers, rallies encounter less resistance and corrections become shorter and shallower. What once slowed the market now accelerates it. When the institutions designed to manage volatility stop doing so, price no longer climbs. It escapes. For most of its history, silver has existed in a media vacuum. Below certain price levels, it was easy to ignore. It was framed as an industrial input, a niche hedge, or a speculative curiosity. As long as silver remained in double digits, silence was sustainable. That silence ends when the number changes. The Crossing $100 forces visibility. A 3-digit price breaks the narrative that silver is minor or irrelevant. It becomes headline material not because of commentary or advocacy, but because the number itself demands explanation. The episode frames this moment as the end of the media blackout. Once coverage begins, the tone shifts rapidly. Early stories ask why silver is rising. Follow-up stories ask how high it can go. The transition is not analytical. It is emotional. Public awareness expands not through education, but through repetition. The same price appears across screens, feeds, and broadcasts until it becomes impossible to dismiss. This visibility triggers a familiar behavioral response: fear of missing out. Retail capital does not enter cautiously. It enters late and forcefully, driven by the realization that something important is already underway. The move from obscurity to attention compresses years of participation into weeks. The episode emphasizes that this phase does not require universal belief. It requires recognition. People do not need to understand silver's supply dynamics or institutional mechanics. They only need to see that it crossed a line they assumed would never be crossed. The price itself becomes the message. Media attention changes the structure of demand. What was once steady becomes episodic. Spikes replace trends. Corrections become buying opportunities, not because of fundamentals, but because of perception. The crowd arrives after the foundation has already shifted. This is the inflection point. Not when silver becomes valuable, but when it becomes visible. Visibility changes demand, but it collides with a physical market that is no longer prepared to absorb it. As silver moves into 3-digit territory and public attention accelerates, the supply side reveals its fragility. The episode describes this moment as a liquidity vacuum, not because silver disappears, but because access to it collapses. One of the clearest signals comes from official channels. The United States Mint has suspended sales of its most recognizable silver product. That decision is not framed as temporary inconvenience, but as confirmation that inventories are already under strain. When demand rises, the primary retail outlet is no longer able to respond. Private mints face similar constraints. Production delays, sourcing challenges, and logistical bottlenecks limit their ability to scale output quickly. Even when silver exists somewhere in the system, it cannot be converted into retail products at the speed required to meet sudden demand. Time becomes the scarce resource. This is where the disconnect between paper price and physical reality becomes unavoidable. Spot prices may reflect futures markets, but retail buyers encounter something else entirely. Premiums expand. Availability contracts. The price on a screen becomes a reference point rather than a transaction price. The episode emphasizes that this shortage is not evenly distributed. Institutional buyers continue sourcing metal through long-standing relationships, while the public encounters empty listings and rising markups. The result is a two-tier market, where paper remains liquid and physical does not. As demand surges into a constrained supply chain, price loses its stabilizing function. Higher prices no longer bring more metal to market. They simply ration what remains. This is the defining feature of a liquidity vacuum. Not absence, but inaccessibility. When everyone wants silver at once, ownership becomes a privilege, not a purchase. Once silver enters a scarcity-driven phase, price targets stop behaving like forecasts and start behaving like consequences. The episode frames the possibility of $300 silver not as a speculative ceiling, but as the mathematical result of structural realignment already in motion. The core reference point is the gold to silver ratio. For much of modern history, this ratio hovered far above its long-term norm, reflecting decades of distortion in silver pricing. As silver accelerates and physical supply tightens, that distortion begins to unwind. A collapsing ratio does not require new demand. It requires only that silver be repriced relative to gold. Historically, periods of monetary stress compress the ratio sharply. When trust in paper systems erodes, silver tends to outperform because of its smaller market size and dual monetary industrial role. In such environments, modest shifts in capital allocation produce disproportionate price effects. The episode emphasizes that vertical markets ignore disbelief. When price moves are driven by supply constraints rather than sentiment, conventional valuation anchors fail. Resistance levels that once appeared logical cease to function. What appears extreme in isolation becomes inevitable in sequence. $300 silver is presented not as a guarantee, but as a scenario consistent with ratio normalization under scarcity conditions. The number matters less than the mechanism. Once silver is forced to reprice within a shrinking physical float, upside expands faster than intuition allows. This is not the language of hype. It is the language of compression. Years of undervaluation, leverage, and paper expansion resolve in a narrow window. Price does not climb smoothly. It snaps into alignment. When the math takes over, disbelief becomes irrelevant. The episode makes a critical distinction that is often lost during vertical moves. Silver is not the destination. It is the vehicle. Its purpose is not to be held indefinitely, but to be exchanged at a moment when monetary distortion peaks. Throughout history, precious metals have served as transitional assets. They absorb purchasing power when paper systems fracture and release it into tangible wealth when price signals normalize. The value of silver is not measured solely by how high it rises, but by what it can be traded for when the imbalance resolves. The recommended strategy centers on conversion, not accumulation. As silver reaches extreme valuations, the objective shifts toward exchanging physical metal for income-producing hard assets. Land, rental properties, and other real assets are identified as endpoints because they generate cash flow and retain utility regardless of currency regimes. This approach bypasses the risks embedded in fiat reinvestment. Selling silver for currency only to re-enter financial markets exposes capital to the same systemic vulnerabilities that drove silver higher in the first place. Conversion directly into productive assets short-circuits that loop. Timing is framed as contextual rather than precise. There is no attempt to call a top. Instead, the focus is on recognizing conditions where silver's purchasing power is historically distorted in one's favor. When silver can be exchanged for assets that once required far more metal, the transition is complete. Silver's role, then, is temporary but decisive. It bridges eras. It carries value through instability and delivers it into permanence. You do not measure success by the price of silver. You measure it by what silver allows you to own. The silver market did not change gradually. It crossed a line. When the Shanghai Gold Exchange closed physical silver above $100, an era defined by abundance, paper pricing, and disbelief came to an end. What replaced it is not yet fully visible, but its outline is unmistakable. Three-digit silver redefines the metal's role in the global system. It breaks the assumption that silver is plentiful, inexpensive, and easily controlled. Physical benchmarks now lead price discovery while paper markets react under pressure. The gap between the two exposes how fragile the old structure had become. Institutional behavior confirms the shift. Banks that once leaned against price are repositioning to move with it. Exchanges adjust rules and products to manage stress. Mints suspend sales and struggle to keep up. Each response points to the same conclusion. Silver has entered a phase where control gives way to adjustment. Public awareness follows, not as understanding, but as recognition. Once silver becomes visible, participation accelerates. Demand collides with limited access, premiums detach from spot prices, and liquidity fractures. What was once ignored becomes scarce. This is not a typical commodity cycle. It is a repricing driven by physical constraint and psychological reset. Silver is no longer defined by what it used to cost, but by what it now represents. The century mark was not resistance. It was a confirmation. The era of cheap, paper-derived silver is over. What follows will not be negotiated.